Children bring a bundle of joy to our lives. Once they enter our life, we want to give them the best. Best food, best school, best secondary education, etc., and secure their future. We want to run after them till they get married and settle down with their spouses. Gifting your child a bright future is every parent's desire. We feel happy as our life revolves around them. But to do all these activities, we need money, and we have to explore lot of investment options. Mutual fund is an excellent option in investing in stock market without investing individual stocks. Just as tortoise stands for longevity, mutual stands for long-term investing. In the recent years, there has been a growing trend of mutual funds designed specifically for children called Children's Mutual Fund. Hi friends, welcome to the channel of Wealthfinmart, and today we will be discussing about the Children's Mutual Fund. Children's mutual funds are goal-based investments that provide for the security of children's futures, whether it be used for school, marriage, or other investments for a rainy day. It is an open-ended investment scheme that will support a child's long-term requirements as they develop. It might be used to pay for the children's first house or their college fees. Is it really important to have a children's investment fund in your portfolio? Let's look at our answer. The escalating prices of school fees have forced lot of parents to look beyond the investments of fixed deposits. 12 to 15% on an average, the cost of education fees are shooting up every year. Also, the focus on extracurricular activities like singing, dancing, etc. are also added cost to pursue the passion for the child. Hence, it becomes extremely important to save and invest in aggressive mutual funds. Factors to be considered while choosing mutual fund. There are a number of things to take into account while selecting a mutual fund for kids. The investing objective is the first consideration. Parents ought to pick a mutual fund that supports their financial objective. For instance, with an emphasis on capital preservation and income production may be more appropriate if the investments is meant to pay for the child's college education. On the other hand, a mutual fund with an emphasis on growth would be suitable if the investments is for the child's long-term future. The mutual fund's level of risk should also be taken into account. Depending on the investing goal, children's mutual fund can range from conservative to aggressive. An aggressive mutual fund invests in high-risk assets like stocks, whereas a conservative favors low-risk investments like bonds. Parents should select a mutual fund based on their level of risk tolerance. The track record of the fund manager is the third factor to be considered. A fund manager with a track record of consistently delivering stable returns is a good indicator that the mutual fund is well managed. To ensure that they are making an informed investment decision, parents should research the fund manager history as well as mutual fund past performance. Start early and regularly. The earlier you start investing, the more time your investments have to grow, so start as soon as possible. Regular contributions can also help you build wealth over time. The cost of procrastination is very high. Be mindful of fees. High fees can eat into your returns over time, so choose low-cost investment options. The fact that children's mutual funds have a high potential return on investment is one of their main advantages. Children's mutual funds enable the power of compounding to work in the investor benefit because they are intended for long-term investments. This translates to long-term growth that is significant because the investment grows and the rewards compound over time. Another benefit of children's mutual funds is that they are tax efficient. Unlike other investments, such as fixed deposits, which are taxed annually, mutual funds are only taxed when they are sold. This means that the investment can grow tax-free until the time of redemption. Additionally, mutual funds offer tax benefits to investors under Section 80C of the Income Tax Act, which allows for a tax deduction of up to 1.5 lakh rupees. A great approach to introduce kids to the world of finance and investing is through children's mutual funds. Parents can impart the value of saving and investing for the future to their children by making an investment in a mutual fund. Also, it aids in understanding of risk and reward in children as well as the functioning of the stock market. Frequently asked questions. 1. What is the targeted audience for children's fund? It is meant for children below the age of 18. Secondly, whether SIP or lump sum be invested in this scheme? Investments can be made lump sum or SIP basis, and there is no maximum limit for investment. Thirdly, is there any lock-in period under this scheme? The scheme will have a lock-in period of 5 years from the date of allotment or till the child attains the age of 18. Whichever is earlier. Some of the recommended children's mutual funds are HDFC Children's Gift Fund Investment Plan, Equity-Oriented, SBI Magnum Children's Fund, ICICI Prudential Child Care Fund. Piloting a dream, doctoring a dream or cooking a dream. You need to start planning today and take one step closer to securing your child's future. Documentation. To apply for a children's mutual fund, following documents are necessary to start an investment. KYC of the parent is compulsory. Child's birth certificate is compulsory. The investment will be done in the minor's name. Child must have a bank account and he should be an account holder. Children today have countless professional options, so we must be ready to fulfill their dreams both financially and emotionally. Investments in equity is the most viable option if you want to earn sizable returns as well as preserve the real inflation-adjusted value of your corpus. Whether it is birthdays, naming ceremonies, or your child's first day at school, an investment in mutual fund can go a long way in fulfilling the child's future requirements. When you have a lot of time to achieve your goals, invest predominantly into equities. As you near your goals, you need to shift gradually to lesser volatile asset class like debts. Having a sound plan at the earliest for child's future would help in overcoming the financial burden in the later years. Remember, all good things in life come with patience. Remember that investing involves risk and there are no guarantees, so it's important to consider your own financial situation and consult with a financial advisor before making any investment decisions. Mutual funds are subject to market risk. Please read scheme-related documents carefully. Thank you for listening and goodbye.